Welcome to our first quarter video update for the year 2021. We've got a lot of ground to cover today, so without further ado, I'd like to introduce our Chief Investment Officer and President of Capstone Asset Management, Glenn Murray, and not to be forgotten, my trusty colleague and fellow portfolio manager, Maria Dawes. Hello, you two.
Hi.
So, Glenn, earlier on this year, we did see the Treasury yield go up, and this led to a market correction of sorts. It seems as though we've been in an environment of an uncertainty ever since. Can you maybe comment on what is your view in terms of rate hikes, and also whether there's a direct correlation here between the increase in market volatility we've witnessed?
You're correct, Janet. We did see a significant move in the bond yields during the first quarter. In fact, since January, we've seen the 10-year Canadian rate increase from 0.68% to 1.55% by quarter end. As the pricing of bond moves inversely to yield, this significant yield increase has resulted in the bond market having a negative performance for the quarter. This does lead to uncertainty for sure. I think that the Canadian Central Bank and the US Fed have been transparent on their current intentions with rate hikes, with the Bank of Canada indicating it plans to hold its rate steady until 2023. Currently, the central bank is stimulating the economy by having reduced its rate from 1.75 at the start of the pandemic down to its current level of 0.25%. Additionally, they are involved in what's called quantitative easing through the purchase of bonds, and that's being done in the amount of $4 billion a week. So my expectation is that they will likely see a reduction in the stimulus through a curb to the bond buying prior to making any adjustments to interest rate hikes. That particularly is with this ongoing uncertainty that surrounds us with COVID variants, vaccination rollouts, as well as lockdowns. So the Bank of Canada is expecting some transitory inflation, as they believe inflation could rise to 3%, which is at the high end of their target range, before returning closer to a mid-range of around 2%. Based on their current outlook, plus the current areas of uncertainty I mentioned, I think it would be a challenge for the central bank to increase the rate this year. The market expectation of inflation increasing is based on perspectives about issues like economic recovery, supply chain disruptions, and the significant fiscal and monetary stimulus we've seen. It's these inflationary views that have been a contributor to the rise in bond yields. However, in response in part to the original question, it's unclear that the lack of a central bank rate hike has contributed to this rise. If it has, then the best thought there would be that people gained comfort early on during the pandemic from the Bank of Canada and the Fed's transparency of the timeline for rate stability. But now, with growing expectations around economic recovery and inflation, there could be a growing uncertainty that the central banks may not act to withdraw their stimulus quickly enough to protect the economy from overheating.
Thanks, Glenn. Let's talk a bit about inflation. I know we've touched on it in the past as well, but do you think that an increase in inflation will negatively affect bond prices going forward? And if so, could that be an argument for incorporating alternative fixed income assets within a diversified portfolio?
I guess I consider myself to be more in the Bank of Canada's camp from an inflationary perspective. However, I would characterize my perspective as being cautiously in that camp. I recognize that there are currently areas where inflation is being felt in the economy, and relative to the depths of the economic realities this time last year, I had expected to be seeing inflation moving up at this point. However, I continue to have a cautious outlook on the employment and wage growth picture, which, if they remain weak, or as we're seeing provincial economies continue to be locked down, these will be a limit on the growth of inflation. Additionally, I'm not convinced that household savings that has grown in 2020 will be more than a transitional boost to GDP without the support from employment and wage growth when the economy opens back up. There's a particular concern in Canada where our perceived success early on in controlling COVID-19 is now highlighting that it's how you finish the race that has equal or greater importance. With the current scenario facing Canada, we will need to monitor unemployment rates and wages, as both could be headwinds to recovery. The outlier to all this will be the upcoming budget, which likely will see additional spending through debt, which will open up the economy to further distortions. How those decisions impact inflation will be interesting to monitor as we move forward. Although many of the current inflationary issues are transitory in nature, I expect that there will continue to be inflation fears that lead to volatility in the bond market. These fears, whether real or perceived, can push yields higher, which will result in capital losses in bond portfolios. So while I agree that there is likely an argument for alternatives caused by this particular concern, I believe the long-term rationale continues to be the real support for the inclusion of non-traditional and alternative strategies in a bond portfolio. That rationale being that their characteristics, such as consistent cash flow, preservation of capital, and low correlation to bond markets, make for a more efficient portfolio when balanced together with traditional bonds. Their inclusion in Capstone portfolios has improved performance and reduced volatility, and with the current traditional market uncertainty, this highlights their role. So considering the current conditions, we are overweight non-traditional assets like private debt and infrastructure due to the traditional market's volatility, low yields, and this uncertainty, as we prefer the stabilized valuation, the improved yields, and limitation of market sentiment that non-traditional investments provide.
Thanks, Glenn. So we've actually had a number of questions about our non-traditional equity fund and its value in a balanced portfolio. Could you maybe speak in terms of how we are expecting to meet our target rate of return in this fund, specifically this year? What are perhaps some changes that have recently been incorporated into this fund?
Yeah, thanks, Janet. When we review the 2020 performance, the fund did definitely underperform its target return. This overlooks some of the principal components of the strategy's role in a portfolio. In the previous question, we discussed a little bit of the aspects of our fixed income pool, which is a hybrid strategy. That is, there's both a non-traditional and traditional investments within the fund. On the equity side, we split this out into separate funds to access the traditional and non-traditional markets, which allows greater customizations in portfolios that seek a balance between these two components of the equity investment space. So as an example, a client that had a 50% mix in each of our two equity strategies would have a 6-year annualized return of 6.56% versus the TSX at 606, with a fraction of the volatility and a significantly higher risk-adjusted return. I use the 6-year performance simply because that's the longest period we have both strategies for their full performance data. So although we did not hit our performance target, over the long run, the fund continues to perform its overall function in a portfolio. However, we have a target for a reason, so we're always looking to ensure we capitalize on opportunities we see. I think a quick review of the mandate of the fund will help highlight these opportunities. This fund's focus has continued to be refined over time to ensure that it complements the traditional market while accessing strong non-traditional investments. The mandate's focus is primarily broken into 3 categories: private equity, real estate, and infrastructure. 2020's performance was contributed to by portfolio transition, as some of our investments were maturing, as well as some being intentionally sold. The early 2020 market volatility highlighted to us some of our investments that were too volatile or too correlated to the traditional market. As such, we sold them early in the year. Now, some of those would have contributed to the upside by year end, but they clearly had demonstrated that their return profile did not meet the fund's mandate and would be better considered for other fund strategies. Between these portfolio adjustments and some investments maturing, the portfolio had a higher cash position. This hurt performance, but also allowed Capstone to reposition the portfolio with a view of the pandemic's impact and to take advantage of the opportunities we see. This has led us to be focused on rounding out the private equity component of the portfolio, and we've made a few additions in this space at the end of 2020 and early into 2021. We do actually expect to make one more addition in the coming months to this portion of the portfolio. This is a space that we believe there exists significant opportunity in select parts of the market, and in fact, we're already seeing a positive contribution to the portfolio. We had one position up over 11% just last month. Additionally, we have had some of our real estate projects maturing and are excited by some of the opportunities that we're having the privilege of reviewing in real estate. The current opportunities under due diligence in the US are showing a much better risk-adjusted return versus some of the Canadian ones. That, coupled with some strategic structuring, will allow the fund's performance to benefit in the short term. 2020 will be remembered as a challenging year for obvious reasons, but for the non-traditional fund, it could prove transformative as the portfolio will have been strategically adjusted to take advantage of the market opportunities seen coming out of the pandemic.
Glenn, can we talk about another one of our funds, because we're now a year into the Capstone Private High Income Pool. So can you give us an update on some of the holdings within that fund?
Yeah, I'd be happy to. This fund was launched with a mandate to provide investors with a diversified exposure to the private debt market, primarily outside of Canada, though. It has a higher risk profile than some of our other funds, but still looks to provide low volatility experience, low correlation to traditional markets, while providing a stable source of yield. We launched this late in 2019, and it hardly begun when the pandemic hit. However, considering the challenges of launching and establishing a fund at the pandemic's outset, the fund held up very well and provided a good return for 2020. Throughout the year, as the fund has grown, we have continued to add in a different mix of private debt strategies beyond the early concentration in real estate. Two key additions are in corporate mid-market lending and aviation leasing. So the mid-market is defined as companies that have revenues of between 10 million and 1 billion. And the group we work with sources opportunities to provide lending through hybrid credit and junior capital structures. The key attraction of investing in this space is that it allows our investments to be positioned to receive a contracted stream of income, typically in the 12% or higher range, while also having the opportunity to participate in equity growth. The target company or the borrower is seeking capital for positive restructuring purposes, such as acquisitions, leverage buyouts, growth opportunities, or recapitalizations. The second addition we're excited about is our relationship with a firm well entrenched in the aviation leasing space. This is a market that has provided an excellent return profile, is backed against a hard asset, and is currently distressed due to the pandemic. We see this as a great time to be entering the market to take advantage of the recovery over the coming years. Currently, there is a deep pipeline of opportunities that will be well positioned to capitalize on the market, stabilizing and growing in the years ahead. Early in 2021, has been an active one for our partner. They've been acquiring aircraft with excellent return profiles. We anticipate, though, that our full allocation will still take until sometime into 2022, as market dynamics continue to work themselves out in the industry. However, the early investments are performing exceptionally well, and we anticipate that this will grow in its contribution to the fund performance as our allocation continues to grow. Finally, we have been undergoing due diligence on the introduction of private debt into the infrastructure space for about a year now, and expect that at some point in 2021, likely the fall, we will make our first loan to a small-scale hydro project. This is a unique opportunity to provide both diversification and yield to the portfolio, as well as invest in a project that has a tangible impact in the community directly through provision of energy, but also through engagement with that community in additional areas.
So thanks, Glenn. This is a general comment, but I'll try to tie it into our funds. Obviously, we've seen the detached housing market absolutely on fire, especially in areas such as Vancouver and Toronto. I guess the question is, what sort of trickle-down effect does something like housing prices or interest rates, for that matter, have on our mortgage funds?
I guess it's more a measure of degrees of impact. Our strategy operates in the real estate market, and particularly the residential construction component. So there is always going to be degrees of effect from the broad real estate market. However, if we start with interest rates, the impact is particularly mitigated in the short term. With our mortgages being for construction and development, the rates at which we lend are impacted by more than just the current bond market rate of interest, as you would see for a more traditional loan on an existing property. For mortgages, the interest rate pricing is heavily based on the credit quality of the deal. So for example, what is the strength of the borrower, the project? What is the exit strategy? How much collateral is involved? What's the phase of the project or the location of the project? Pricing based on credit worthiness and project quality adds an element of insulation against interest rate moves in the short run. Obviously, longer term interest rate adjustments will contribute to the repricing of risk, but with short average maturity cycle, we have ongoing opportunities to adjust this within the portfolio. In respect to the general market performance, then this depends on how broad the reported market is. So in the current environment where it's very broad, that is beyond kind of the Toronto or the main city centers, and also broadly across residential property types, then it does have a positive influence on the portfolio. However, in many situations, you need to understand the different market dynamics like affordability or market supply, the product type, the employment picture, or even the regional economic strength to fully understand what that impact would be. With respect to the current interest rate volatility, we have seen little to no impact during the first quarter of 2021 on the portfolio. And the broadness of the market strength has contributed in a positive manner to project sales, as our focus has and continues to be residential property, primarily outside of Toronto, which has been a particular focus of buyers' interest during the pandemic.
So far, it's been a strong start to the year, which is nice to see. And on our last video commentary, Janet and I spoke about FOMO, or the fear of missing out, which we felt was very well received. Glenn, at this point, we still have pretty high unemployment and stimulus checks are still floating around. And it seems like everybody has become a day trader overnight. I feel like this has magnified the hype in certain stocks and sectors, things like cryptocurrencies, EV stocks, NFTs. I guess this trend can be both an opportunity and a danger. How do we find that balance? And how does Capstone approach these sorts of trends or hype sectors?
I would definitely agree with you on that perspective. In Canada, we saw incomes rise in 2020, not because of the wage growth, but the government distributions. This extra cash, coupled with time on people's hands, has contributed to the popularity of day trading again. It's important to recognize there are some key differences between Capstone's mandate versus these types of investment opportunities, which really restricts the nature of our interest or involvement. It is also important to recognize that during all this hype and potential overvaluation, there are key components that are legitimate advancements or marketplace disruptions that will likely have a key impact in the economy in the future. Capstone is not currently investing in cryptocurrencies or non-fungible tokens, but does believe that blockchain technology is revolutionary and will be a key disruptor moving forward. We'll never deny that there is money to be made from some of these market opportunities and that there is a place in certain investors' portfolios. However, the volatility, risk of capital loss, and challenge of identifying the winners from losers is not consistent with our philosophy of capital preservation and avoiding short-term speculative investments versus long-term consistent returns.
Glenn, we want to thank you so much for your time, as we know you are such a busy guy. We truly appreciate hearing your thoughts and insights, and I know our clients do too. So we thank you once again, and for now, we bid you farewell. Maria, parting thoughts or comments?
Yeah, that was great. It's always a special opportunity to hear Glenn's thoughts directly, and hopefully he will join us again at the end of the second quarter. Jan and I are also planning on doing our own video update in the next few weeks, so please stay tuned for that. And just a reminder that should you wish to find out about any of the opportunities that we spoke about today, please do not hesitate to get in touch with us by either phone or email. So bye for now.
Bye.